Hi, everyone. This is episode 3 of the Capital Compounder Show, and today I'm joined by Paul Harris. Paul is at the Harris Douglas asset management firm now, but he was originally in my book Market Masters, which released in 2016. And Paul, I would love to hear about that move from the old firm to you starting the new firm now. Please tell us about it.
Yeah, so I think that one of the things that I think about the industry and how it's changing, specifically with the private client side, is that how do you help people and with their money, right? And so, yes, you can say that you invest their money for them, and that's like what most asset managers sort of say they do. But managing wealth and helping grow somebody's wealth is far more complicated than just saying, I'm going to try and beat the TSX or whatever the index you have, try and beat and pick a bunch of stocks. It's more about this kind of holistic approach. So you have to think about other aspects of their wealth, right? Whether it's kind of financial planning, which is something that we do here with my colleague Stephanie Douglas, my partner in the firm, right? So that's really important because you need a financial plan, and the importance of a financial plan is that it sets a kind of foundation from which you work from going forward. So with a financial plan in 2020, none of our clients really called us and said, "Oh, the world's falling apart. What do you do?" Because they knew what they were going to be doing, right? So having a financial plan, kind of constantly every year or every 2 years, updating that plan is really important. Obviously, investing is important. I do that here, and we make a very strong effort to that. But we also think that tax is important. So how do you having a good accountant. So we have an accountant that works with our clients and does their personal taxes for them. We have a lawyer that does wills and powers of attorney. All those things. And then the last part is that we do insurance here. So it's kind of a holistic approach, a family office for people that we bring all these people together. They're not employees of ours, so they don't have an interest in selling our stuff to anybody or specific things. They're really to work with the client to engage them in understanding how their world is changing over a period of time, right? And what they need to help them with those changes. So, you may have a cottage somewhere that you're gonna that's worth a lot of money, but how do you offset that risk, right? So you maybe need insurance to do that. How do you take out money from all your different accounts is so you don't pay as much tax, right? So having an accountant understand all those things. So it's really a culmination of bringing a lot of these services together in one place, and I think that's very different than what a lot of other asset managers do, where they just say, "Well, I'm going to manage money because I'm a investment guru," and really, if you look at the numbers, most people are not investment gurus. They're kind of average gurus, and they can tell you they're investment gurus, but they're really not, and the stats show that. So what we're trying to do is say, your wealth is more important than just investing. It's all these other things, and if you bring all those things together, you can actually grow your wealth in a much better way and I think have a better uh, overall view of the future of your wealth, because you're doing all these different things, right? So that's what really it's about. It's very different than I think other asset managers in my old firm as well, is that we want to be able to bring these things together for a client. And I like to, the kind of the elevator speech, if you will, is we're a family office for people with 1 million to 10 million. Because if you have more than $10 million, you can have your own family office probably. So that's kind of the idea we're trying to think, is that it's a family office for people who would normally not get the services from in that way, from other because you don't have the wealth to be able to do that. And I think that's the really important thing about the way the market is changing, the asset management industry is changing. And I think you have to give credit to the banks in many ways and the brokerage industry. They really have been doing this for many, many years. It's just more the kind of traditional asset managers that maybe you talk to or don't do this, right? They tend to be just investment people. And I think as the world has become different, that's just not enough anymore. You can't just say I'm an investment person. And I don't think it helps anybody just doing that as well. So that's
So
kind of
you've created a one-stop shop for your clients, and the investable assets range from 1 to 10 million. Um, Without naming names, who are some of these clients? So this is a lot of wealth to amass before they come to you. Like, I'd love to know where they make their money basically before coming to you.
Yeah, so I mean, we started off with less people with less than that, but as more and more as we've grown the firm, more and more people have larger amounts of money. I mean, I think it's not that hard to envision. I mean, they're mostly professionals. Maybe some people own their own businesses. Some people have they're professionals and they've grown their wealth. I think there's a funny little thing, like what we try to think about is even if we get somebody that has a little bit less than that, the idea is that they become very wealthy very quickly because there's a kind of a very narrow line between cost and income when you first start off, right? And I think you may have talked about this in some of the things you've done before. It's a very narrow line because you're not saving as much because you have kids and you have a house and a mortgage and all that stuff. But as you get better job and all these other things, that gap widens and widens out. And what we're really trying to do as a firm is get them when they're kind of it's very narrow, but when it widens out, we get the benefit of that gap that opens up, right? So we're not, yes, we get some people that don't have a lot of money initially, but the idea is that they become wealthier because like a lot of costs into stabilizing, and so the revenue part of it goes up a lot, and we capture that gap. And the issue is that for us is that if we get them earlier on, we provide all these services. It's harder for them to kind of exit the firm necessarily because we provide them with all these other things, right? So, and as you get older, you kind of you maybe want insurance, you may want other things like a will and power of attorney. When you're 25 or 30, you don't think about dying or any of those other things, but having those things are really really important because if you don't have a good will and a power of attorney, and especially in the world we live in today, it can
Hmm.
cause havoc for your family and havoc for your person who's going to inherit the money and stuff like that. So it's much more complicated today than it was years ago. And so I think that offering these services binds those clients to us, and we're really trying to get that. And the beauty of this business, as you know, is it creates a great annuity. If you can keep a client for 30 years, that's fantastic, right? And so that's what we're trying to do is kind of build this group of clients and keep them for long periods of time.
Yeah, it's amazing how much has changed in 10 years, right?
Yeah.
Since first interviewing you, releasing the book Market Masters. Um, can you talk about some other changes that have happened in the industry itself? We were chatting just before this, and you had mentioned that you used to put out a quarterly newsletter, but then you've gone to now a 2-minute clip for clients. And can you talk about
Yeah.
that change and some of the other changes?
Yeah, absolutely. So I think that one of the things that in this industry, what happens is that we do stuff because somebody else before us did it. So, and that's kind of a weird thing, but that's just the way the world is, right? So when I started my company with Avenue, we used to write quarterly letters, and when I started this new company, we used to write quarterly letters. The beauty of a quarterly letter, though, when we send it out, we actually know if people open it up because you can look at all this data now which you never had before. You just sent it out or you emailed it out, I mean, you've mailed it out to them. You never knew if they read it or not, but now you actually know whether somebody opens up the email to see if they read the letter. And what I found over a period of time is, even though I spent time on these letters, nobody was really reading them. And I think that there's a lot of issues around that people have shorter attention span. Videos are far more useful to them. They can listen to it in their car, they're just on their phone, they can listen to it at their computer or their iPad. So there's many mediums which they can actually kind of look at these things, right? So what we decided to do is really on a quarterly basis just do a short video to our clients telling them what's going on in the portfolio, any changes that we've made, anything that we think is going to be interesting over the next quarter, and that's really it. And it's 2 to 5 minutes, given what's going on in the world. But that's more valuable, and we've got very good response, right? So I think that is much more useful than sending out a letter which no one's really reading. And if you have an elderly client, a lot of them don't want to read it on a screen; they have to print it off, right? So,
Hmm.
so there's a lot of complications. And like I said before, in the 1970s and 80s and 90s, you actually had to write a letter because people didn't have access to information. But today, as everybody has access to information, you walk down to the corner of King and Bay, you know what every stock is doing actually, right? So it's a very, very different world, right? So, and I think that asset managers are very, kind of, I wouldn't say they're not lazy, but I think that they think these traditions are important, and so they kind of continue with them even though they're not valuable to their clients even, right? They think it's valuable to their clients. It's not valuable to their clients. Clients are younger people do not read stuff like this. They read everything online or they listen to
Hmm.
stuff. So you have to adapt, I think, and I think it's much harder for people traditionally in this business to adapt because they came from a world where these were all things that were done, and they think that it should be done now, and I don't think that's necessary. And I think that if you don't adapt, like in anything in the world, right? You have to push yourself even with technology. Even though I'm an older person, not elderly, but older, I have to push yourself with technology because it's all changing, right? And if you don't do that, you run the risk of becoming irrelevant, I think.
I love that. So we're in December right now, 2024. Let's do a little bit of a year in review for 2004. Paul, tell us about some of the highlights for you. Tell us about some of the surprises that you saw in the market, if you can just reflect.
Yeah, so you read a lot of these things, and a lot of people send out all these yearly things, what's going to happen, and 90% of them are wrong, right? So I really, I never like to predict anything. The only thing I like to predict for my clients is tell them that there's going to be volatility, right? There's always going to be volatility. So I view the world as, when I see the world and what's going to happen, I don't know what's going to happen next year. I think there's going to be a lot more volatility in the first quarter because the new administration comes in. They're going to try and do a lot of things in the first 100 days, et cetera. So there may be more volatility. But, I've always felt that volatility, in chaos, there's opportunity. So if there's volatility, that allows you to actually buy things cheaper, right? So to me, the volatility is important in an ongoing basis in the stock market because it allows you to access companies that you really like or existing companies that cheaper multiples, right? So I think in 2024, I think people were felt that we were going into this recession. It was going to going into from 2023, you're going to go into a recession. I think there's this feeling at the beginning of the year that rates were going to fall precipitously in the United States. All those things didn't happen, right? And that inflation was going to come down, but it certainly didn't come down as quickly as people felt, but it has come down a lot. Um, I think on the Canadian side, there's a real feeling that we are in much deeper problems in this country than the United States, and so I think that that's why you've seen rates come down much more aggressively here than they have there, and the Canadian dollar weaken a lot because of that as well. So I think people didn't predict all these things, and I don't think people get them right very often, right? Saying all that, I mean, I think what you have to do, and I think you've talked about this when you've done some of your videos, is to really look and buy good businesses, right? Good businesses, yes, they may have a harder time in a recession, but they will survive a recession. It's not Ford, which has gross margins of 5%, right? Like you don't want to buy. We tend to buy. There's a lot of problems with the stock market because people buy lousy businesses all the time because they want to buy them for 6 months and sell them to buy something else. So that's not what you're supposed to do. You're supposed to buy really good businesses, and there's not many of them. Like there really is not many of them. Just because it's a public market, a lot of people come public because they need liquidity, not because they're good businesses, right? So there's a lot of terrible businesses in the stock market. There are very few good businesses. There's a guy by the name of from Arizona State University. He wrote a paper, Heinrich Bessenbinder. That's his name, I think. And he was a professor. He's a professor at Arizona State, and he basically did a white paper and showed that since 1929, about 4% of the stocks are made up of all the returns in the stock market since
Wow.
2022 or something like that. So really, what you're supposed to as an asset manager is look for great businesses, right? And great businesses obviously have a great business. Obviously, people forget this. Great businesses actually have certain metrics. They're all the same. Like the metrics are all the same. Like if you go and that's why when Warren Buffett reads something and he goes, "I can go buy this company in 2 minutes," because he's just looking at these metrics and goes, "That's why it's easy for him to do that." I'm not comparing myself to him. I'm just saying that it's easy for him to do that because he understands what makes a company work and he understands what a good company has, right? And so good companies have certain metrics. They have good gross margins. They get good operating margins. They get great free cash flow. Like there's these metrics. If you look at them on companies, you will know it's a good business, right? And I can put that, I can do that with someone who is in first year university. I guarantee you, and they'll pick the best company because if you tell them, okay, this is what a good company has, right? They'll pick a good company because those metrics, if you show them that, they'll say, oh, well, this is a good business, right? Because of these metrics. So I think that people buy lousy businesses a lot, right? And they don't buy good businesses, right? And I think that's our job. Well, my job is to look for good businesses, right? And look for these certain metrics. And I think in our business, because there's so much noise and all that stuff, right? You have to have a discipline, right? And this is counterintuitive. Discipline frees you. It doesn't inhibit you, right? People think when you have a discipline, it inhibits your ability to think out of the box and all that stuff. No, discipline frees you, right? It makes you forget about all this other nonsense that's going on around the world and concentrate on what's important. And that's a hard thing to do in the world we live in today, right? Because you're inundated by so much stuff so especially on the finance side, right? There's so many things going on. And so I think that you have to have a discipline. it may be different than somebody else's, but a discipline, and that discipline will free you from all this other stuff around you and help you make the right decisions. But picking a good company, I don't think is as hard as people think. It's just that people don't want to pick good companies. They want to pick the thing that they think is going to go up 10 times or whatever, right? So I mean, like I'll buy this stock that's trading at $5 because I think it's going to be a 10 bagger. Like that's just not. They're not good businesses, right? You need to look at the data, look at the company, and most good businesses are very consistent, like they are, right? And so and sometimes they fall off the cliff a little bit and stuff like that, or they miss something or whatever, and you have to then make a decision about whether they're going to continue to be a good business, and that's part of my job. But I don't think it's that hard to pick a good company, and I think you've talked about this a lot of times,
Yeah.
right? Picking good businesses they have these metrics. You look at these metrics and you say, okay, this is a great business. Yeah, and you don't have to own 50 of them or 100 of them. You can just own 20 of them, right?
Hmm. Hmm.
And you can do very, very well.
It's the keep it simple strategy, right? So this is a
Yeah.
perfect segue. So you run segregated portfolios now for your clients. Has your investment strategy though evolved at all over time from Avenue till now, or has it
Um,
basically stayed the same?
no, I don't think it's really evolved. I think I'm what I've realized is that we tend to be much more U.S. orientated because I think there's better companies there. There's some great companies in Canada, but there's not as many, and that's just a nature of our country. Like we're a small country, and this happens in a lot of small countries where there's a lot more cyclical stocks here, and you don't have these kind of great uh, kind of technology companies, healthcare companies in this country as you would in other parts of the world, right? So I think that that's part of the problem. So it's more, a little bit more U.S. based, definitely. But outside of that, I don't think my way of thinking about businesses. I think when I read this Hendrik Bessenminder article, it really opened my mind to understanding that it's very like you have to look for these good businesses, right? And they're few and far between. So that kind of opened my mind a little bit to change how I think about stocks a little bit and look for these kind of businesses. Excuse me. So I think that that's what I've tried to do, but outside of that, I don't think I've changed very much. But I would say I've changed a lot since I first started investing and when I got out of university and stuff like that and bought stupid things, right? But that kind of period of time, over a period of time, I think everybody does that until they find, you know, how do they think about companies? What do they value in a business? What do they look for in businesses? How do they, what do you look for in management? And I think the trouble is that people tend to look at management a lot, and I think that's it's a very uh, it's really not it's not something that I think I care about as much as I used to, right? If it's a small cap company or a mid cap company, yes, but a large cap company, most management never tell you anything. Like they don't, you can go listen to all the CEOs of the banks in Canada. They don't tell you anything because they're not allowed to. It's illegal, right? So they don't really tell you much, or a lot of these big companies don't tell you much because they can't. So management to me is less of an issue. I mean, it's important that they have good management. I get that, but that you can tell that by looking at some of the numbers, right? If it's good management, the company's probably run well. So I don't really put as much value as I did maybe when I first started off because everybody goes, "Oh, you have to talk to management," blah blah blah. I think I value that less than I did years ago, right?
It's all public exactly for these blue chip larger corporations.
Yeah.
So walk us through, Paul, a recent stock selection so we can better understand your process, basically.
Yeah, so I bought a company called MSCI, which is the MSCI group of indexes, which you see people use to benchmark against their performance. And one of the things I liked about this company is that it's capital light. Obviously, there's no capital expenditure. They don't have a lot of capex. They have they have lots of very high gross margins, very great operating margins, lots of free cash flow. The asset management business and the traditional asset management business may be declining, but the ETF market and the indexing business has grown quite rapidly. So you have to benchmark against something, and you have to, and one of the reasons I like this company, there's only really three big players in the business. So it's an oligopoly. There is MSCI, there's S&P 500, and there's the FTSE, right? So those are the only three things that people can use to benchmark against. And as an asset manager, you can't use your own benchmark. You can't create. So you know what I mean. So one of the issues is that they face is that they go, oh well, but you can't. Like I can't. If you're an institutional money manager, and you go to your client and say, well, I'm going to create my own benchmark, they're going to say, no, we want you to use a benchmark that's you have no influence over. So these things continue to do well because of that. I think the other thing that they've done very well is they've made acquisitions because there's a huge amount of growth happening in alternative asset classes. So they've bought a real estate business, so they can do benchmark real estate. They're looking at other asset classes, and buying up kind of benchmarking products from that. The other issue with a lot of this stuff is that there's a lot of analytics that goes on with benchmarking, right? So people go, oh, well, it's just the index, but people want, like, if you're a big institutional money manager and all these other things, or even if you're running retail funds and stuff like that, you have to understand the analytics within the benchmark, not just the number, but the stocks inside it, all these other things. So they get a lot of money because not only are they selling the indexes, but they're selling a lot of analytics and risk management around portfolio management, right? So there's many different revenue streams. So I like that kind of business. I think the asset management business will grow. It may grow in different aspects, whether it's ETF market or whether it's kind of alternatives. But these guys are well placed to do that, and they don't really they throw off tons of free cash flow, right? And to me, that's really key to how
Hmm.
you want to think about a business. They have very little debt, and and indexes will continue to be used by everybody over the more and more as people have to benchmark against something, right? So in Canada, people would use the S&P TSX, which is owned by the S&P, of course, but in for MSCI World, MSCI Emerging Markets, all these other things, they've got a great and so I think that that's the kind of business that you want to own. A lot of free cash flow, very high gross margins, very high operating margins, kind of, and an oligopoly where they really can't. There's only a few people. And then the other thing is that one of the things you have to remember is that if you run against an index and you picked MSCI, as an asset manager, you can't go changing it every time you want to, right? You kind of have to stick with what you've got. So it's not like you can get rid of it. Now you can obviously change that index if the portfolio changes, and you can talk to whoever your client is, but it's much harder to do that. So there's quite a strong annuity with all these things, right? Now, I'd say the risk to the portfolio, that particular stock, is BlackRock is a very large client of theirs, right? So some of these big ETF guys are very large clients of theirs. So that's obviously one of the problems. But I think it's minimal. And so when you look at retention rates on these guys, it's well into the 90s all the time. So they don't really lose clients a lot, right? And when they do lose clients, it tends to be because a merger happened in the asset management business. So you've got two companies, and they don't need, obviously,
Hmm.
you're only using one product right from them. So that's when they kind of lose clients, if you think about it. But they don't really lose clients because, we don't want to use you anymore. You have to use some kind of index to benchmark, right? So I like companies like that, like very capital light, right? Lots of great gross margins, right? Continue to be able to do that. They can make acquisitions. It's an oligopoly. There's very few people they compete with. So I think that's a great business to have.
Thanks for walking us through. Can you tell us the data sources that you rely on, Paul, to select these stocks? Like, where do you go?
Um, so I use a company called Refinitiv to get my pricing of my stocks and stuff like that, and they have a lot of data on there, and also I usually just go to the company if I like a company, I've read about them somewhere, I think it's interesting, I'll just go to their website and download their annual and read that quickly, and some of their quarterly stuff, and then I will just go to kind of Refinitiv and download data that I want to see about these companies, right? And like this is the problem I think and this is the tough part for me I get a lot of people calling me about jobs and stuff like that in the investment industry, and I worry that like these jobs with analysts and stuff like that are going to go away a lot faster than people think, right? And financial data is very clean. Like, I mean, when I started in the investment industry in 1990, we had Excel, but you had to go to the library, get 3 years worth of annual reports, type it all in, and run all the formulas. And then Refinitiv and Bloomberg started taking all this data, but they still had annual reports, and they were typing it all in, so the data was very dirty, right? Then all these companies started. Everything comes digitally now, right? From financial services, like everything, like every company is digitized, all that stuff. So the data is very clean. if you want to, you can go to Yahoo and probably get 20 or 30 years worth of data on Microsoft. So the data is like the problem with the financial services industry. The data is all available. It's all there. It's like AI will have much more influence on those things. And so as an analyst working at some of these places, I think those jobs will have to go away because you don't need as many people doing this, right? A machine will be able to do it for you and give me, like the way I think about looking at a company, I mean, if a machine can give me all that data in a way that I think is acceptable, then what do I need somebody to tell me about that stuff? Like it just, and like when we just discussed, you're not going to speak to management because management's not going to tell you anything, but and machines already listen to management conference calls anyways, right? And tell you, oh, the guy said cost 30 times and said this 25 times and all that stuff. So there's machines already doing all this stuff, right? So I think the risk to our business, especially on the financial services side, is that all the data is very clean. There's lots of it. It's very accessible, and so machines will be able to not pick a stock, but certainly be able to give you all the information for you to pick a stock, right? But in other areas like manufacturing and all that stuff, the data is not clean. It's all over the place. It's very messy. It's going to take a long time for them to clean all that stuff and make it usable for them to make decisions about their businesses, but not in financial services. So I get
Hmm.
worried that you're going to see a lot of people slowly these jobs disappear. Like, you
Chat,
may not,
yeah,
if you have 50 analysts, you may go down to 20, right? That's not, and I'm not, but I think it'll happen a lot faster than people think,
I agree.
right?
Chat GPT could become your next security analyst. Have you dabbled with Chat GPT? Have you
Yeah,
just
that's why.
thrown in some files and
Yeah, oh,
questions?
that's
Yeah,
exactly why I feel this
that's
way
cool.
because I've typed in stuff and it's not perfect. Don't get me wrong, but perfection with that kind of stuff will be exponential, right? It'll all of a sudden boom. So so it's not like so. I think that that's the problem, right? And if I was a large asset manager, I'd certainly be investing in these kind of things to be able to access that information because you're paying somebody, I don't know what you pay an analyst at some of these places, a couple $100,000 a year, plus you have to pay for benefits for them. It's not having somebody sitting in a seat probably cost you $400,000, right? Maybe five, I don't know. But I think I worry that these jobs are just all going to be gone in the next, not gone, but certainly drop in the numbers over the next. And people tell you that, like when you talk to somebody, oh, that's not going to happen. Yeah, it's going to happen. It's going to happen a lot faster than you think, right?
Hmm.
And if I was
So true.
management, yeah. So, anyways,
So, like, if we can talk about your philosophy on the concentrated portfolio versus the diversified, how do you run your portfolios?
so I would say they're concentrated, which to me concentrated is between 25 and 28 stocks. So that's what I think of concentrated as. They are not. They are diversified maybe by sectors, but even by sectors. I would say that if I liked a sector, I would overweight it. I have no problem with that. I believe that's, well, you asked me what I changed. I don't believe in diversification as people think about it anymore. Like just being in Asia or Europe or all these things. I don't think it works. I think it's actually dumb, right? I don't think it works. I think you're better off picking great companies and wherever those great companies are. Like, so let me just give you an example. I own Microsoft, right? So Microsoft has businesses all over the world. Like I get diversification through Microsoft because they're dealing in Asia, they're dealing in Europe, they're dealing in Latin and South America, they're dealing in Africa, they're dealing in every part of the world, right? So that's one thing I think that people miss about that stuff. And I don't have to own something in China because I don't know the accounting, I don't know any of those things. I can own a company like Microsoft that may deal there or deal in Asia, and I don't have to worry about that aspect of their business, right? So I think that there's a lot of people put a lot of emphasis on diversification, but what you're really doing, in my view, is you're diversifying. You're not diversifying risk as much. You're diversifying returns and getting lower rates of return because you're going to a place which may not be have great returns, but you're doing that because you think you're helping your client, and I don't think you are. Excuse me.
Hmm.
So I don't think you are, but I think that so I don't believe in diversification in that respect. I think you can diversify maybe through sectors, but I really don't feel uncomfortable if I like a sector to overweight it. I think that you want to buy good companies, and if you're buying a good company, whether it's in any kind of sector, I don't own cyclical stocks. I own one oil company, so I stay away from cyclical companies. I think that they're just bad investments over long periods of time. So you can see that you go to healthcare, you go to technology, you go to some financials because although they're cyclical, there's some financials. So I don't own a lot of sectors which I think, especially in Canada, which are I would say too volatile for my the way I think about companies. And the other thing is I don't believe that you should hedge your currency. I think the reason for that is that I own big cap stocks, and most of these big cap companies have a hedging process inside their companies. Like, Microsoft has a massive treasury group that knows all their cash flows and hedges all that stuff. Why am I going to be able to think about it? So I don't do that at all. And I think that because you're buying a long duration asset in a stock, in fixed income, if you're buying foreign fixed income, I would hedge it because there's the end date where you have to that thing matures. But equities are long duration assets, and so I think the price appreciation of the security will outweigh the impact of the currency on the portfolio. So I don't hedge any of those things. I think that's a bad way of investing. I don't think that I'm not like I own a company called Novo Nordisk, which is a Dutch company, right? Sorry, not Dutch company, a Danish company. I don't mind investing internationally, but I always buy them actually in New York on an ADR basis. But I don't mind doing that. But I'm not interested in being in a different country. So I'm in Japan because whatever, right? That just doesn't make any sense to me anymore. And that's one of the things I've realized over periods of time that you don't diversify that way, right? And you get a lot of diversification by owning, you know, even some Canadian stocks, right? You get diversification by in different parts of the world, right? So,
Mhm.
so I think that we miss out on that stuff because we've kind of like again, this comes back to this issue that this is where you were thought, this is what you thought was important, this is what everybody told you when you're reading stuff and things like that, and that's actually not, it's not valuable, right? And I think that that's what I've come to the conclusion. I know other people, who run pension plans and all these other things may say, oh, that's you're totally wrong, but for what I do and for what I have with my client base it's not really that diversification like that is I think kind of pointless.
I completely agree. That's how I run my own portfolio. It's concentrated, and I just focus in North America. You can find
Yeah,
amazing quality, top tier companies just here.
yeah.
So 25 to 28 stocks in the portfolio. Talk about position size. How do you determine position size?
Um, well, I usually tend to buy something between sort of between 3 and 5%. I don't really buy things at 1% and hope it, all that kind of stuff. So I want decent sized positions in the portfolio because they have to make a difference, right? If I believe in the company, why do I not want to own a decent sized position in it, right? So that's one thing. Um, the one thing I will say that I do is that I may not like if a stock gets to 8 or 9% or 10% of the portfolio, I may trim it a little bit, but I would never sell the whole thing because of that. I think we tend to sell good companies too often in the world. That's the other thing I think that happens a lot in our business. We tend to sell good companies or because they've gone up. Oh, it went up 10%. I got to sell it, right? No. Yes, they may move sideways for a while, but if they're good businesses, they'll continue to grow. So I don't really sell that. The other thing I will do though is if I have a company that's gone from, let's say, a 3% position to a 9% position, right? New clients coming in, I may buy them at 6 or something like that. That's the only thing I try to do to kind of manage the risk of the portfolio a little bit. But I tend to own these stocks, even if they get to be even more than 10%. I probably still own them because I think they're great businesses. I think we tend to be, oh, you have to sell something, or there's no reason to sell a great business, right? I mean, I think the problem with Warren Buffett is that people tend to quote him and talk about him and pretend that they're having breakfast with him every Saturday at his some place, and they don't listen to what he says. And the issue is that you own these great businesses, and you let them compound for forever, right? And so yeah, and so I think that that's what I've learned is that if you own a great business, yeah, they may have a difficult time or something like that, but if they're really great businesses, they will kind of continue to grow, and you selling them doesn't help you at all, and selling them and going and buying something else. I think is a flawed methodology in the long run. So I tend to own these things for long periods of time, and some of them get to be pretty large positions. But I will trim them a little bit if I feel that they've gotten to be so large that I would never let something get to 30% of my portfolio. That's what. But I would, if it got to 10, it wouldn't bother me at all.
Yeah, there's no point in interrupting the compounding process at all, right? By selling
Yeah.
completely out of a position. So Tell me about the one or two or three stocks that you've held for the longest in portfolios. I'm curious.
Novo Nordisk was a company that we've held since I started Harris Douglas. So we bought it, and I didn't buy it because of this weight loss drug. I bought it because of diabetes, which is a terrible disease, but it's growing quite rapidly in the United States and Canada. And in China as well, like people overweight in China is very high. So they were the largest producer of insulin, and that's why I bought it. And then this thing happened, right? But I believe that this drug is world changing, right? I think that it's going to, yes, the stock fell, blah blah blah, but it is world changing because it is, there's a lot of problems that come along with obesity, right? And it's very intuitive, right? You're overweight, you have heart disease, you have stroke, you get diabetes, you get sleep apnea. I mean, it's
All of the
pretty.
chronic conditions,
Yeah,
right?
all the chronic, and the problem in the United States and in Canada even, is becoming like this. Chronic disease is the worst possible thing, right? Hip replacements are caused by all the obesity, knee replacement. So we are paying for a lot of these things because people are overweight or obese, and I think that these things are going to help people get to a weight that's reasonable, right? And so I believe that this is, and it's also thinking about like people drink less alcohol and all these other things. So there's other impacts that it's having on people that people are forgetting, and I think that's really important. So I've owned that for a long time. Royal Bank of Canada is another stock I've owned for a long time. Royal continues to, I don't know, just like it just has this ability to just like no one gets above its market cap for very long, and then it falls
Yeah,
apart.
it's the curse.
It's cursed, but I'm sure that'll happen at some point in time. But I think it's a really well-run bank, and it's got a lot of it's got a lot of, and it's fairly domestic, right? In many ways, it's not like TD, which went and bought a bunch of retail thing. I mean, their international stuff tends to be in asset management and all these other things, and they've got a great investment banking group. So I think I liked Royal. Microsoft is another one that we held for a long, long time. I really liked the idea that what's happening with the cloud and how they move to that. AI will certainly help them. And AI will help them a great deal because they're really much more of an institutional, like they deal with big companies and stuff like that. So that's going to help them a lot because those are the kind of companies that are going to need a lot of work to help them with AI to generate higher productivity and use their data to understand it better for all kinds of different reasons. So I think that will help them a lot. Google's another one that I think it's probably one of the cheapest stocks today. I think that when you look at online advertising, will continue to grow. Search, I don't care what anybody says. Like nobody goes and goes, oh, I'm going to go to Yahoo to look up stuff. Like they just go to Google, right? So it's a great business. I think that YouTube is a great business. I think that people undervalue. I had a friend of mine that as a host, but he had a little kind of a bunkie that he wanted to build, and he just did it all through YouTube, right? Like he
That's
just went onto
awesome.
YouTube and just found out how to do every single thing, in that bunkie. Like so, to me, it's kind of people just use it for everything. Like so, I think there's a lot of aspects of it. I mean, all these companies are always going to face kind of the DOJ and wanting to break them up. But I think it's very hard to break up these companies because they're very vertically integrated. There's nothing. So don't get me wrong. I think there should be regulation around a lot of these companies. That's very different than saying, "Oh, we got to break them up." That's not going to help anything, right? And they will, if you break them up, they will figure out a way to still do all these things anyways, right? And I think breaking up businesses was a very bad thing in many ways. Like if you look at the Bell business and all stuff, they're all back together effectively, and the oil guys are all back together. So I think that breaking them up is not the idea, but regulating them is very important, right? They have access to a lot of things that are really important. So regulation is very important, and regulation that doesn't stifle kind of creativity and growth in those industries, right? I mean, what's made the United States, and I know they use this word exceptionalism in the United States, what it has made them incredibly powerful is the fact that they have, these great technology companies, but more importantly, people in the United States have access to capital. And even this country, we just don't, getting capital to do work, risk capital is very hard here. In the United States, it's, if you need 20 or 30 million dollars, it's probably a lot easier to get it than anything, right? So you can just come up with it. So I think that's the beauty of the United States, and I think that's very important. And no one's been able to replicate that in the world. No one, right? American, I mean, Canadians haven't been able to do that. Maybe we're a little bit better. The British haven't, especially the British. I mean, they've got great universities there and stuff like that, right? And Europe has not been able to do this. And so I think it tells you something, right? So, and a lot of those places in those people in those countries actually just go to the States because they know they can get the capital very easily there, right? So I think that it's a very different model, and they are, it's exceptional in that respect, right? That's what's exceptional about it, that they have this ability to access risk capital very easily there, and you don't have it in this even in this country. It's very hard, even though we're so close to them, right? We've not been able to duplicate that, and we have great universities. In fact, I bet you tons of people from Waterloo go to work in Silicon Valley. And so I think that's kind of so I think that. That's kind of, I think, very interesting, right? So we need to, and I think that's why the U.S. is going to continue to do well. I mean, maybe it's not going to do as well as it has in the last little while, but regardless, these companies are going to do well, and I do like them because I think that they have all the things that I appreciate, right? High gross margins, lots of free cash flow, very good balance. Well, no debt, most of them, right?
They're predictable businesses, right?
Yeah,
Like we
very
can't see them
predictable.
going out of business anytime soon.
Yeah, very predictable. Like even the digital advertising. Digital advertising. No one does print advertising anymore, right? Very few places. And what I'm shocked about it on the print side is that it's still so expensive. If you want to put an ad in the Globe and Mail, it's ridiculously expensive. Like, why would you do that, right? So I think that digital advertising is growing rapidly, and the other one I've owned for a long time is Amazon as well, which I think is an incredible business, not only on the retail side and people, it's very low margins, but listen, I mean, you can, while you're talking to me, you could get on and order something on Amazon, and I bet you they'll be able to deliver it by the end of the day. Just it's unbelievable that
Yeah.
they can do something like that, right? And the logistics, that they've figured it all out. Their advertising business is growing rapidly. The cloud, they were. Yeah, they had all they were the largest cloud player, and now they're losing market share. And every analyst goes, "Oh, it's terrible." Yeah, it's terrible, but that's fine. They're still number one in cloud. Like, you know what I mean? Yes, and they still make a great margin on that business. So I think that's another company that I think you really have to own for the future.
Agree. Going back to the RBC curse, how no Canadian company can surpass
Right.
RBC's market cap and stay in that position for very long. What company do you think has the chance in the next 5 years, let's say, to actually surpass
Oh.
and stay number one?
Um, I think the only company that really can probably do that is Shopify, right? So I don't think there's any other company that can really, um, m- you know, maybe if TD ever got its act together after all the stuff they've done, maybe they could do it, because if they actually kind of clean up their U.S. franchise and stuff like that, I think it's very, excuse me, I think it's very hard. Like I think Shopify is probably the only one. I'm not like, I don't know who else could be able to do that. I mean, it's probably some like a technology company. If we have another one of that level, that would be able to do that. I think it's not. I think Nortel did that, and then BlackBerry did it, and then Shopify did it. But I think Shopify is really coming into its own in the last little while. Like so I think that may be the company that can sustainably be thing. But I'm not sure of any other industry. Like, no, I can't think of any oil company that can do it in this country, or any resource company. So that's two big sectors. Maybe another bank, but I think that's really hard. I don't know if any other company can really kind of do that outside of Shopify. And I'm not like, I guess Constellation Software, but Constellation Software is a very different business, though, right? It's not. In some ways, it's not a tech company. It's much more of an asset allocation company, right? So,
It's all about the roll-ups, right?
yeah,
Serial
yeah,
acquisitions.
yeah,
Yep.
and yeah. So, I mean, they're incredibly good at it. Don't get me
Mhm.
wrong, but it's not the same thing. I don't think, right?
It,
So,
it says a lot about the Canadian market, because if you look at the U.S., every 10 years there's a new leader,
yeah,
because all the innovation
right.
happening. But yeah, in Canada it seems to always be RBC, and that might never break that trend. Let's talk about the stock that you've held for the least amount of time,
Oh,
um, and the lessons learned.
um, let's talk about it. So actually, so this is so I'll tell you something. In 2023, I didn't sell any company. So I didn't do any trades. And this year I only bought two companies. And the previous year I didn't sell anything, but I got bought out of stuff. So I've really not sold many stocks in my portfolio, right? This thing that I've held the shortest. And we're thinking, what's the company that I held the shortest? I don't. It might have been. I think I originally bought the T-shirt maker. I can't remember the name of it now.
Gildan Activewear?
Yeah, Gildan Activewear.
Gildan.
So, and I think that I bought that because I thought, it was an interesting business and it had sort of a very, when you looked at it over periods of time, it's actually done very well. And then COVID came along and I sold it right then because that and I think Air Canada were the two stocks that I kind of were probably not as confident about. Air Canada I kept for a little bit longer than I sold it. But Gildan I sold right away because close to after, well, into 2020, but I sold it because you realize very quickly that a lot of their business came from kind of these events and things like that, and there's nothing going on, right? So, saying all that, I guess the stock has done well over the last little while, right? But those are the only two things. But they were ended up being not the kind of companies I should have bought anyways because Air Canada is much more of a cyclical company anyways,
Mm-hmm.
right? So, and I actually thought originally, like we all thought about COVID, it's going to be 2 weeks or 1 month or 2 months or whatever, right? And then you'll realize, oh my God, this thing's going on forever. So that was kind of a big mistake that I made, which I kind of held on to some of these things when I probably should have just got rid of them right away. And because they weren't kind of naturally the companies that I like to buy, but I bought them. Gildan's slightly different though. Gildan has had a very good track record over a period of time, and even Air Canada, it looked like it had changed its business. It was very at the top of the airline business and stuff like that. But I mean, COVID damaged them to a degree that I didn't expect.
Mm-hmm. Um, let's talk about trading strategies. Do you employ any trading strategies, like for risk management, or to maybe to add some more alpha throughout the year?
No, I don't do any of that stuff. Uh, I hold a lot of these things. I've come to the conclusion that to be a really good portfolio manager, you have to be lazy. And so I try to be as lazy as possible. I shouldn't be telling this on this call because, excuse me, it'll be one of the things you put on your video. But I don't mean it like that. I mean, what I mean is that I think that sometimes you do too many things, and my job is not to do that, right? My job is to do the least amount because I like these businesses, right? So, and that it's hard. It's really, really is the hardest thing in this business to try to do nothing, right? Because there's so much information coming to you constantly all the time, and you feel like you should be doing something. So it takes a lot more to say I'm not going to do anything, and just concentrate on what I have and understand. I the quarterly reports. I read all their quarterly reports. I do all that stuff to make sure the companies are on track to do what I thought they were going to do. But I think that it's very hard in the world we live in today um, that it becomes easy to do something and it's harder to do nothing. And so I kind of try to make myself do nothing. So I feel that's the best way to do this. And it comes back to this issue very simply about uh, you know the people getting a letter where they can't read it because it's too much time, right? And they'd rather listen to a 2 to 5 minute video. Well, it's the exact same thing I think in our industry where there's just so much information coming to you that you sometimes feel you need to do something and you shouldn't do anything, right? And on a quarterly basis even, I would never sell a stock because they missed a quarter. Like that would just like that's a world of somebody else. Like it's the hedge fund world or some other world out there that does that kind of stuff. I would never do that because I believe in these companies and missing a quarter means nothing to me, right? It's yes, and the volatility. The tough part about that is that there's so much volatility in the stock market that those things can fall 5 or 10% very easily because they missed their quarter. But that's not how I would think about a company ever, right? It's just not. I buy these things for the long term. Missing a quarter
Yeah.
means nothing,
And
right?
it could be an opportunity to maybe add to the
Yeah,
position rather
yeah,
if you have that long-term
yeah,
time horizon.
yeah.
So let's start thinking about 2025, and this is the very exciting part about the conversation here, Paul. Tell me about your best ideas, and I know you don't like predicting anything too
Right,
far out, but if you're to pick, let's say, three of the companies that you're most excited about for 2025.
right. So I think. Novo is one of the companies I'm very excited about going into 2025. I mean, the stock has fallen. I think it's a great time to buy it here. So I think that they're coming out with a lot of information about uh, what these drugs are going to be doing. So I think that, and the other thing is that there are only two companies that really do this: Eli Lilly and Novo, right? And so I think there are other companies working on this stuff, but they're not even they may be at phase 2 trials. They're not even coming close to FDA approval. And the other problem with which people really forget about the drug business is that you have to manufacture these drugs. They just don't automatically appear, right? You have to and manufacturing is hard. Like it's one of the problems they've had, right? Is that they have had to scale up manufacturing, and it's taken a long time, right? So I think people don't understand. Drugs don't become pills just by some magical thing. They are manufactured at a place, and running a drug company requires that ability to do that very effectively. So, and it's not like semis where you just give it to Taiwan Semi to make your drugs. Like you have to make them yourself, right? So I think like so I do think Novo is a great story. The one risk to Novo, of course, is that unlike Eli Lilly is a much more diversified pharmaceutical company, right? Novo has other things, but this is their big drug. So I like that. I think Google or Microsoft, either or both, will continue to do well because I think AI uh, is is a game changer in many ways. I don't know if you're going to see the fruits of it all the time right away, but it is a game changer. It really is going to change. Like we just talked about the finance industry, it's going to change many, many industries. And I think these guys are at the forefront of it. It's very expensive business to be in, and so these guys have lots of capital. Um, and I think that Amazon's another company that I really like. So there are a lot of tech companies in there. Um, so I think like those are the companies that I think I definitely would keep throughout next year. I think they will have maybe a difficult quarter or something like that going into the first quarter. I think the whole market may have a difficult quarter in the first quarter because I think the Trump administration comes in, they're going to try to do a lot of changes. It may be more volatile, etc. But I think by year end, I think these companies will do well, and I think you're going to see this the fruits of a lot of the stuff on AI happening over the next couple of years, right? I do believe it's going to, they're not. It's not going to take over human beings, but I think it may, but I do think there's a lot of applications that people don't quite understand that these things are going to be able to do, right? Whether it's even just taxes, and there's so many different things that these machines can do very easily, right? And so I think that so I think it's going to be very interesting over the next several years, and I think that those companies will benefit from it a great deal. I'm just trying to think of anything else that I really like. That will go into. I like MSCI because I bought it recently. I do that. I think that'll do well. I bought.
Speaking of innovation, though, Paul, would you ever look into Tesla?
I have looked into Tesla, and I think that so there's two things. One is that I think Tesla is a very interesting company, right? Because one, the problem with the other car companies is they're trying to be a combustion car company and a EV company, and it doesn't work, right? So that's the first thing, and so that's one thing. The other thing is that this it's basically Tesla is basically an iPhone, right? I mean, he's created an iPhone, right? But you don't go to a dealership and talk to some guy and try to bargain with them. You just get on the website and order your car. Like, what's so hard about that, right? And so that's one thing. He's got so much data on on the car industry, on people driving the car and all this other stuff, which is very, very valuable, right? So I think that he is so far ahead of everybody else on that thing. I've always kind of, I just never figure out when the right time to buy it was, but I definitely would own it. I think that uh, I would say the only thing that I'd say that he has to do is make a cheaper car, like a I think he was going to come out with a model. I can't remember what the number was, Model 1 or
It's
Model 2.
Model 2, I think he's thinking
Yeah,
about.
right. So I think that would be a car that the average person would want to use, right?
Hmm.
Because I drive a Toyota Corolla. I'm not going to spend $80,000 on a car. It doesn't matter what anybody tells me,
That's
right?
good to know.
Yeah,
That's right.
yeah. I'm not doing that, right?
I'm
It's
sure
just
clients would like to hear that too, right?
well, I
That's
don't want
great.
to buy a depreciating asset, right? Like, and
Yeah.
I'm going to drive that thing for 15 years and then I'll buy another one, right? So, but I want to buy something if I'm going to buy. I mean, for me, I only drive in the city. It's actually totally makes sense for me to own an electric car, right? Absolutely makes sense for me to do that.
Yeah.
But I'm not going to spend $80,000 on a car or $90,000. I'll spend 30 or 28 or whatever my Tesla, my Corolla cost me, right? But that's it, right? So I think that that's the problem. And so the funny part about this, and he actually said this. He goes, "There's only going to be one company that there's only going to be the Chinese that compete with me on cars, right?" And he's right. They're the only ones that are going to compete with him on an electric car, and they can make an electric car for $30,000, but not then they've put taxes on it. So we're living in a very ironic world where we want people to move to electrification, and then we're taxing we're tariffing the people that can bring in the cars the cheapest, right? So I don't, and I think that you're going to have. It's going to be a long time, but I think he's way ahead of anybody. That's the whole thing, right? And I think he's very, um, you know, uh, you can't, like, the guy is brilliant, right? And so and I think that when you talk to him, he might be crazy about other things, but he's brilliant about and he likes manufacturing things and putting things together. So I think,
Hmm.
and it's a beautiful car. Don't get me wrong. Like, the other thing is that if you look at this car relative to a Volt or something like that, they're just so ugly. Like, I can't understand why North Americans can't make a good-looking car. It's a good-looking car, right? It just looks good. Like, it looks sleek and it looks all those things, right? Whether I've never driven one, but it has all. It looks like a great car. And if you're even if you're a sports fanatic or something, you look at that car and go, oh, it looks very sporty. I wouldn't feel uncomfortable being in that car, right? So I think he's done a lot of things that make those cars fantastic. But I think that I think you need a lower model for it to be acceptable by the average person, right? But I think he's got more data than anybody else. I think self-driving will come along in the next few years, whether it
Hmm.
be Waymo or whoever. Excuse me. So I think that that's kind of. But I guess there's times I thought I should buy it, and then I don't know why I just didn't do it. So it was foolish, I think.
That might happen. Let's have some fun. So, hypothetically, if you were to pick one company, January 2nd, to start shorting, what would that company be?
Oh, I don't know. I don't know if I wouldn't. I don't short anything, so I'm not very good at that kind of stuff. So I don't know what stock I would short. I don't know. I mean, I've never, like, you have to be so right when you short, and you have to be right away. That's the big difference about
Yep.
shorting, right? So it's not a, like, it's
Borrowing cost.
yeah, it's so I don't.
Exactly.
I've never shorted anything in my life. I've always been sort of a long-only investor, so I don't really know. But if I had to short something, like, I would say the way I think you have to think about it is companies that have sort of very large capital expenditure, or companies that are not like the tech companies or something like that. Something that's really more cyclical in nature and stuff like that. I think it's easier to short something like that. But I don't really short. So I feel bad I can't answer that question. So
Okay. All good. What's the best part of your job, Paul?
um, I think the best part of my job is really trying to help people. Like, I feel one of the things I managed when I was at TD Asset Management. I managed mutual funds, right, and the TD Bank Pension Fund and stuff like that. And I really never saw any of my clients, right. And then when I went to New York and worked there for 3 years, I did institutional money, but they were just a group of board members that you met. And they weren't really the people who you managed the money, you lived off this money. And this particular job, where I actually meet people and help them with their wealth, and know their lives and know about their children and all these other things, I find that really, really enjoyable. Now, I will say one of the bad aspects of COVID was the fact that you get to meet your clients less and less, and when
Hmm.
after COVID, a lot of them just sort of just kind of don't come down here anymore and stuff like that.
Mm.
But I like the idea that I really help people. I can make a difference in their lives. I can make a difference in their retirement. I can, because, and if they stay with me for long periods of time, I can see when they're retiring and how to get them their money, and so it really makes a big difference to me, that aspect of it. I love the investing part of it. I like it, but like I said to you, it's not the be all and end all of what I do anymore. It used to be, and I felt it was the most important thing, and it was a kind of cool thing to do. But it's not the most important thing when you're trying to help somebody with their wealth. It's one of the things, and it can be important, and it is important at certain periods of time, but it's not the most important. It's the most important thing is having a relationship with somebody, understanding what their risk is, understanding what their needs are, how they want to retire, and trying to set up a portfolio that helps them get to that point where they can enjoy their life, right? And so that is very enjoyable about what I do today. And you can see it on an ongoing basis, which I really appeals to me. But like I said, I love investing. I will always do it, and I think it's very enjoyable to look at a company and analyze it and pick good companies. But it's not in the world of private client, it's not the most important thing anymore.
Tell us about the best or your favorite investing books you've ever read.
Well, I guess the most important book I've ever read is probably Intelligent Investor. I think that I think so. I know you read a lot of books about this stuff, and you talked about it, right? I think you only have to read one book, or whatever. Like the problem with all that kind of stuff is most of it doesn't change, right? I would say analyzing a company over the last 100 years has not changed at all. I mean,
Hmm.
we just think about other things, right? But so Intelligent Investor, I read that when I started in the business, and I found it very helpful to understanding, a company and what to look for and risk management and all those other things. But I think it's the only thing you need to read, right? I think people read a lot of these books, and I think that they're not necessarily in highlighting anything more, right? I mean, the other thing I think is worth reading is all Buffett's letters. I think they're very good, and they're very well written, and they're intelligent, right? So those are the things that I think you should read, and you'll get a better understanding of how to manage money from those things. But it's not as I think we put too much emphasis on these things because people are, it's an industry, right? People write a lot of books, but I don't think they say that many different things, right? And that's what I've come to the conclusion about. So I think that if you read The Intelligent Investor, if you read Buffett's kind of letters, his history of his letters, I think they're very valuable and give you insight into the world of investing
Hmm.
and simple things that you what not to do and what to do, right? I mean, I know we're not splitting the atom here, right? Like that's not that complicated. I think we try to make it complicated because we want to justify existence sometimes. What we do is not that complicated. It's interesting, and because the world changes so quickly in our business. It's kind of fascinating like that, and bad things happen like 2020 or 2008, and so there's valuable lessons you get from that as a person working within that thing, right?
Yes.
But it's not. A lot of things don't change, right? Analyzing a company didn't change because of 2008. It's the same thing. I didn't change how I look at a business, right? I mean, that experience was important for me to understand what happened in 2020 and stuff like that. And I think that's kind of what, the longer you're in this industry and you see these big things happen, you can understand the world a lot better. And when bad things happen, you know what to do, right?
Hmm.
So I think that is really what's really important. The other thing I would say what's been important for me is I started off on the fixed income side, and people undervalue the value of understanding the fixed income market, right? And I think that's really important for young investors. So I think that they tend to think of stocks because it's cool and I'm buying a company and blah 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 blah. But understanding fixed income, and I think people forget all the bad things in the world happen in the fixed income market first, and then they happen in the stock market. The stock market is an adjunct in many ways to the fixed income market, right? A bad company has excessive amount of debt, right? That causes the problem for the stock market for them, right? It causes them to the stock to collapse or go bankrupt. A country has too much debt, they go through a lot of stuff, right? 2008 was a fixed income event that culminated in a stock market event, right? 2020 was a fixed income event that culminated in something happening in the stock market. It wasn't the other way around. It was the fixed income market had happened first because there wasn't enough liquidity in the system in 2020 when you're shutting down everything. No, people forget companies borrow money in the long end of like do bonds, but most of them for working capital reasons and all that stuff borrow money in the short end. And so if you freeze up the short end of the money market curve, companies can't pay their bills, right? So I think that's like so fixed income to me coming from that experience made me realize a lot of different things that I feel I'm more equipped to deal with the investment world than somebody else who just came from the equity side, right? So I think
Yeah.
fixed income it's less valued in the world we live in because it's just not as interesting sometimes. You don't go to a cocktail party and say, "Oh, I bought the, 2.5% of 2050," and I mean, no one talks like that, right? But they go, "Oh, I bought this great company," right? And it went up and blah 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 blah. They talk about those kind of things, right? They don't talk about fixed income in the same way. But I think that, excuse me, the fixed income market really helps you learn about a lot of things that people forget, right?
Yep. Before we close out, Paul, tell me what you enjoy to do outside of work.
Oh, well, I really like, I like to read a lot of fiction. I think that's what I really enjoy. I like traveling a lot. So
Mhm.
personal travel, not business travel. I mean, business travel is business travel, but I really like to travel personally with my wife and my daughter. Um, but I really like reading fiction. I mean, I think that there's so many wonderful novels in the world that people don't read. And I'm not trying to be critical. Like people read a lot of business stuff, and that's fine if you want to do that. But it's not
Yeah.
my bag of tea, right? So I like reading fiction. I think it's beautiful to read a novel about uh, uh, personalities and people and the world we live in. And and the world is harsh, right? Not always you know cherries. So
Nope.
so I think the world is harsh, and I think we forget that. And so fiction lets us know about a lot of these things. And I think I would get more pleasure uh, reading, Pride and Prejudice by Jane Austen than I think I would get reading some business things. So I don't really read any business stuff anymore. I mean, I read stuff that I have to read for work, like the New York Times, the Financial Times of London. I read Globe and Mail. I read those papers. I read some other stuff, and I when I do read that, I concentrate on that. But my life is not about that. It's about enjoying your life, and I think that fiction allows you to gives you it takes you away from the present world, and I think that that's the wonderful thing about novels, right? They export you to some other place and some other time and in some other situation, which are not always. Sometimes those situations aren't pleasant, but we don't live in a pleasant world. We live in a very harsh world in some ways, right? And
Yeah.
so it's nice to kind of experience that in your head at least. So.
Love it. It was great catching up, Paul.